If you turn 70 and a half this year and you think the only thing that milestone means is get ready for required withdrawals, you could be about to overpay the IRS by thousands of dollars without even knowing it. Most retirees hit this age and just wait for the government to tell them what to do next. And heads up, none of what I'm about to walk you through is personal advice. It's general information, so let's get right into rule number 1, because this first one alone could put real money back in your pocket this year. Here's the scenario I want you to picture. You're 71 years old. You've been diligently saving for decades. You've heard that required minimum distributions don't kick in until age 73 now, so you figure age 70 and a half doesn't really apply to you anymore. It's just an old number that Congress left behind when they raised the RMD age. That assumption is exactly where retirees start leaving money on the table. Age 70 and a half never stopped mattering. It's still sitting quietly in the tax code as the exact date certain valuable strategies switch on, whether or not you're required to touch your retirement accounts yet. And because the RMD age moved to 73, a lot of people never even hear about what became available 3 years earlier. Think about how strange that actually is. Every single year, millions of Americans cross this exact birthday, and almost none of them get a letter, an email, or a phone call explaining what just opened up for them. The IRS publishes the rules. Your brokerage might mention one of them in fine print buried in a quarterly statement, but nobody sits you down and walks you through the whole picture. That's exactly why this milestone gets treated like an afterthought instead of what it really is, a real financial turning point. This isn't a rumor or a workaround. It comes straight from the tax code itself. The rule allowing charitable transfers directly from an IRA at 70 and a half was written into law back when Congress made the qualified charitable distribution rule permanent, and it was never tied to the RMD age. Even when RMDs moved to 72 and later to 73, the 70 and a half trigger for this specific benefit stayed exactly where it was. The IRS lays this out plainly in its retirement plan guidance, and the earned income and spousal contribution rules I'll cover next both trace back to the Secure Act that Congress passed a few years ago. None of this is a loophole in the shady sense. It's simply written into the code, and most people never get past the headline, RMDs start at 73, to see what else changed underneath it. And here's why that matters so much financially. Every one of these 7 rules touches one of 3 things. How much of your income the IRS actually counts against you, how much you're forced to pay in Medicare surcharges, or how much of your money eventually reaches your kids instead of the government. Miss even 2 or 3 of these, and over a 10 or 15-year retirement, you're not just talking about a few $100s, you could be talking about tens of thousands of dollars that quietly slipped away because nobody explained the rule at the right moment. So let's go through this properly, one rule at a time, starting with the one that catches the most people off guard. Rule number 1 is the direct charitable transfer. The moment you turn 70 and a half, you're allowed to send money straight from your traditional IRA to a qualified charity, and that money is never counted as income on your tax return. For 2026, the cap on this is $111,000 per person. So a married couple could move over $220,000 this way in a single year if they wanted to. Here's a real example. Say you're 71, you take Social Security, and you have a decent pension. Your income already puts you close to the first Medicare surcharge tier. If you write a $6,000 check to your church or a hospital from your personal bank account, you get a deduction only if you itemize, and even then it might not help much. But if that same $6,000 goes directly from your IRA custodian to the charity, it never touches your bank account, and it never touches your adjusted gross income at all. That's the part most retirees get wrong. They either write a personal check and lose the benefit entirely, or they take the withdrawal first and donate it after, which means they already paid tax on it. The money has to move directly from the retirement account to the charity, with your name never appearing as the recipient, or the IRS treats it as a normal taxable withdrawal. Let's put real numbers around why this is worth the extra step. Say your adjusted gross income this year is sitting at $105,000 as a single filer, and the next Medicare surcharge bracket kicks in right around $109,000. Every dollar of regular income pushes you closer to that line. Now say you were already planning to donate $5,000 to a cause you care about this year anyway. If you just write that check normally, it does nothing to lower your reported income. You're still sitting at $105,000. But if that same $5,000 flows out as a direct transfer from your IRA instead, it never touches your income at all. And if you're also 73 or older and have an RMD due, it counts towards satisfying that requirement too. You give the same amount to the same cause, but one version protects you from a Medicare surcharge and the other doesn't. The mechanics are the entire difference. The process itself is simple once you know it. You call the company holding your IRA, Fidelity, Schwab, Vanguard, whoever it is, and tell them specifically that you want to make a qualified charitable distribution. They'll either wire the money directly to the charity or cut a check made payable to the charity that you mail in yourself. Either way, your name is never on the payee line, and that one detail is what keeps the transfer invisible to the IRS as income. Now here's where it gets important. Rule number 2 is that you can keep contributing to a traditional IRA no matter how old you are. For years, retirees were told that once you hit 70 and a half, the door closes, no more contributions, period. That rule is gone. It was repealed, and today a 75-year-old and a 25-year-old follow the exact same contribution rules, with one catch: the money has to come from actual work. Social Security, pension income, and investment income don't count. It has to be W-2 wages or self-employment income. So if you're 74 and you're doing part-time bookkeeping, tutoring, or running a small Etsy shop, every dollar of that income can go straight into a traditional IRA up to the annual limit, and you get to deduct it from your taxable income for the year. Picture a 74-year-old who earns $9,000 consulting part-time. If they contribute that entire amount to a traditional IRA, they just knocked $9,000 off their taxable income for the year, money that would have otherwise been taxed at their regular rate. Most retirees never even consider this because they assume retired means done contributing forever. And it's worth pausing on how many people this actually applies to. Retirement doesn't look the way it used to. You've got former teachers doing substitute work a few days a month, retired electricians picking up small side jobs for neighbors, former office managers doing seasonal tax prep or bookkeeping for local small businesses. None of that income has to be huge to matter here. Even $3,000 or $4,000 of part-time earnings, fully contributed to a traditional IRA, is $3,000 or $4,000 that never gets taxed at your current rate. It grows tax-deferred instead, and you decide later, on your own schedule, when you want to draw it down. There's also a version of this that catches even more people off guard. You can make this same contribution to a Roth IRA instead of a traditional one, as long as your income falls under the Roth income limits for the year. The earned income requirement is identical, but instead of a deduction now, you get tax-free growth forever and no required withdrawals later. Which one makes sense depends on whether you'd rather lower this year's tax bill or build a completely tax-free bucket for later. But either way, the door that most retirees assume is permanently shut is actually wide open. Here's the part they never tell you. This benefit doesn't only apply to the spouse who's working. Rule number 3 is the spousal IRA, and it's built specifically for households where one person works and the other doesn't. If you're 76 and fully retired with zero earned income of your own, but your spouse is still working and earning a paycheck, the two of you can file jointly, and your spouse's income can fund a contribution into your account too. For 2026, that means up to $8,600 into each of your accounts, over $17,000 sheltered as a couple, based entirely on one person's paycheck. Think about a couple where the husband is 68 and still working as a contractor, and the wife is 77 and fully retired. As long as they file jointly and his income covers it, she can still have a full IRA contribution made in her name, even though she hasn't earned a dime from a job in 8 years. Most couples in this situation assume the retired spouse is locked out completely, and they leave that entire contribution on the table year after year. This one hides in plain sight because most people think of an IRA as something tied to their own paycheck, full stop. If you personally didn't earn it, you assume you can't put it away. But the tax code looks at the household, not just the individual, as long as you're married and filing a joint return. So if your spouse's income is enough to cover both contributions combined, both of you can be building tax-advantaged savings every single year, even though only one of you technically has a job. Over 5 or 10 years, that's not a small difference. It's tens of thousands of extra dollars growing tax-deferred that would have otherwise just sat in a regular taxable account, getting taxed on interest and dividends every single year along the way. Most people stop here, but don't, because rule number 4 solves one of the most common fears retirees have: getting hit with a huge tax bill from a forced withdrawal while they're still working. If you're still employed and you have a 401k with your current employer, you can delay taking required minimum distributions from that specific plan for as long as you keep working there, even if you're 74, 78, or 82. Say you're 75 and still working full-time, earning $70,000 a year. Without this rule, you'd also be forced to pull tens of thousands of dollars out of your 401k on top of that salary, potentially pushing you into a much higher bracket. With this exception, that 401k just keeps growing untouched until you actually retire. The fine print matters here, though. This only applies to the 401k at your current employer. Any 401k from a job you left 5 years ago still requires withdrawals on schedule, and so does any traditional IRA you own. There's also an ownership limit. If you own 5% or more of the company you work for, this exception doesn't apply to you at all, and you're still required to take your distributions on time. Here's why this matters more than people realize. Required minimum distributions from an old 401k or a traditional IRA get added directly on top of whatever salary you're already earning. If you're pulling in $70,000 from your job, and the IRS also forces you to withdraw $18,000 from an old retirement account, that's $88,000 of taxable income in 1 year, potentially bumping you into a higher marginal bracket on the top slice of that income, plus higher Medicare premiums the following year because of how the surcharge lookback works. The still working exception on your current employer's plan means at least that portion of the problem doesn't exist. You decide when the money comes out, not the calendar. One more detail worth knowing: this exception only protects the plan at the job you're working right now, today, this year. So if you switch jobs, or if your employer gets acquired and merges your 401k into a new plan, check whether that plan explicitly allows this delay, because not every employer plan is set up to offer it the same way. Rule number 5 might be the most misunderstood of all. There is no age limit on converting a traditional IRA to a Roth IRA. People hear Roth and picture someone in their 30s just starting out, but the IRS puts 0 age restrictions on this move. You can do a Roth conversion at 74, at 85, at 95, it doesn't matter. The real strategy here is timing it during what's sometimes called a low-income window, a stretch where your taxable income drops, maybe because you stopped working but haven't started Social Security yet, or your pension hasn't kicked in. Say you're 71, you retired last year, and you're deliberately waiting until 70 or later to claim Social Security for the higher payout. During that gap year, your taxable income might be unusually low. Converting $20,000 from your traditional IRA to a Roth during that low-income year could mean paying tax at 12% instead of 24% later, once your full income sources are all flowing again. And once that money sits inside a Roth, there are no required withdrawals during your lifetime at all. It can just sit there growing, and if you pass it on to your kids, they inherit it completely tax-free. This is the strategy financial professionals sometimes call filling up the bracket, meaning you look at how much room is left in your current tax bracket before you'd spill into the next one, and you convert exactly that much, no more. Say the 12% bracket for your filing status goes up to $47,150 in taxable income, and after your standard deduction, your taxable income this year is sitting at $30,000. That leaves about $17,150 of room still taxed at 12% before you'd cross into the 22% bracket. Converting up to that amount this year means every dollar converted is taxed at the lower rate, and you avoid converting the next dollar at a rate you didn't need to pay. The generational piece of this deserves its own moment too. Under current inherited IRA rules, most non-spouse beneficiaries, your adult kids for example, have to empty an inherited traditional IRA within 10 years, and every withdrawal they take is taxed as ordinary income to them, often while they're at the peak of their own careers and already in a high bracket. An inherited Roth IRA follows the same 10-year timeline, but every dollar that comes out is completely tax-free. Converting some of your traditional IRA to a Roth now, while you're in a lower bracket, can mean handing your kids a tax-free inheritance instead of handing them a tax bill along with it. Rule number 6 is one almost nobody uses correctly: using your health savings account to pay Medicare premiums tax-free. Once you enroll in Medicare, you can't put new money into an HSA, and a lot of people assume that means the account is basically frozen and useless. It isn't. Whatever's already sitting in that HSA can still be withdrawn tax-free for the rest of your life, and Medicare premiums count as a qualified expense. That includes Part B, Part D, and Medicare Advantage premiums. The one thing it does not cover is Medigap or supplemental plans. Say you're 72, your Part B and Part D premiums are getting deducted straight out of your Social Security check every month, totaling around $230. You can withdraw that exact amount from your HSA and reimburse yourself, completely tax-free, effectively freeing up that $230 of your Social Security check for anything else. Most retirees never touch their HSA after enrolling in Medicare because they assume it's a debt account. It's not. It's a tax-free reserve sitting there waiting to cover one of your biggest fixed monthly costs. Let's stretch that example out over a full year, because the monthly number can hide how large this really is. $230 a month is $2,760 a year, every single year, coming straight out of your Social Security deposit before you even see it. If you have $30,000 sitting in an HSA from your working years, you could cover roughly 10 years of Part B and Part D premiums using money that's already tax-free, instead of pulling that same $2,760 a year from a taxable account or a traditional IRA, where every withdrawal adds to your reported income. The reimbursement process is simple too. You don't need a receipt from Medicare mailed to a special address. You just track what you paid, keep a record of the premium amount, and withdraw the matching amount from your HSA whenever you want, even years later, as long as the expense happened after the HSA was opened. Rule number 7 is the medical expense bunching strategy, and it's built around a threshold most people never hit by accident. You're allowed to deduct qualified medical expenses that exceed 7.5% of your adjusted gross income, but if your medical bills trickle in a little at a time across different years, you rarely cross that line. Say your adjusted gross income is $60,000. The threshold you'd need to clear is $4,500 in medical expenses before you get any deduction at all. If you get dental implants in November of one year and hearing aids in February of the next, you might spread $7,000 of expenses across 2 tax years and never clear the threshold in either one. But if you intentionally schedule both procedures in the same calendar year, that combined $7,000 blows past the $4,500 mark, and the amount above that threshold becomes a real, itemized deduction. This takes a little bit of planning with your dentist or your audiologist, but timing large medical expenses into the same year, instead of letting them drift across 2 years, is often the difference between getting a real deduction and getting nothing at all. It's worth knowing what actually counts toward that threshold, because it's broader than most people assume. Dental work, hearing aids, prescription eyeglasses, a wheelchair ramp, or a walk-in shower installed for medical necessity, even the mileage driven to and from medical appointments, all of it can be added together toward that 7.5% line. So if you already know you need 2 or 3 expensive procedures over the next couple of years, the planning question becomes simple. Can any of them be scheduled into the same calendar year as the others, so the total actually clears the threshold, instead of quietly resetting to 0 every January? And remember, this only helps if you itemize your deductions, instead of taking the standard deduction. So before you schedule anything around this strategy, it's worth roughly estimating whether your total itemized deductions, medical expenses, state and local taxes up to the cap, mortgage interest, charitable giving, would actually beat your standard deduction for the year. If they wouldn't, bunching medical expenses still helps your health, but it won't move your tax bill. So here's the one thing I want you to actually do this week. Pull out your most recent tax return, find your adjusted gross income on line 11 of your Form 1040, and check where that number lands relative to the Medicare IRMAA brackets for this year. Those brackets are published on Medicare.gov. Just knowing which side of the line you're on tells you immediately whether a strategy like the qualified charitable distribution is worth pursuing before the end of this tax year. And it takes about 5 minutes. None of these 7 rules require anything complicated. They just require knowing they exist, because the IRS certainly isn't going to call and remind you. Every one of them has been sitting in the tax code the whole time, waiting for someone to actually walk you through it instead of just handing you a pamphlet about required minimum distributions. If this helped you see something you missed, hit subscribe, because next week we're breaking down exactly how the Medicare IRMAA brackets work and the specific income number that triggers each surcharge tier.